You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Tuesday. And Tuesday will rhyme with T.U.R.F investing today. T.U.R.F investing, what is that? Well, that is a kind of like an old way of investing, super classic, super straightforward, easy to understand, and that acronym actually worked for an entire generation. And that acronym stands for four kind of like subsectors that are very good in Canada and that have made the wealth of a lot of investors in the 80s, 90s, early 2000s probably. And I'm wondering today if it's still relevant. So you got four sectors. So T for telcos, U for utilities, R for REITs, and then F for financials. And today I'm starting to think, well, considering that a lot of investment have been made, a lot of debt has been taken in the past 15 years before the interest rates started to ramp up in 2022. Now we have like a different kind of world. Is it going to be the right place to invest? So I just thought of like doing a quick review of those four subsectors to see what is interesting today in Canada. So let's start with telcos. And of course, my thought about like, is T.U.R.F investing dead was literally driven by what has been happening in telcos. If you look at like the big wireless guys, Rogers, Bell and Telus, it has not been a good 2-3 years, right? I mean, over the past 5 years, they all struggled, and since 2022, it just has been a downward spiral for them. The problem is quite simple. They all struggled to grow their revenue. So the revenue growth last year was about like 1-2% for each Roger, Bell, and Telus. Interest charges is ramping up. Cost of labors, all the other costs are actually increasing. They still have to spend massive amount in capital expenditure to maintain their network, to invest in 5G, to try to explore new ways to make money, to invest into growth, and that creates a cycle of debt that is really hard to get out of. And today they're all struggling. They're struggling because, I mean, they're not about to go bankrupt, but are they going to be a thriving sector going forward? I'm starting to doubt it, like big time. And if you look at other companies like Cogeco Media or Quebecor in Quebec, those that have more revenue driven by the cable industry, not exactly a super fast growing industry either. So I'm starting to ask questions on my side, like, is this part should be a big part of my portfolio? It's never been, actually. So I don't have to do this for my portfolio, but maybe for yours, that could be a question that is interesting. So at this point, I see them a lot more like deluxe bonds than anything else. Still hold to my TELUS shares right now. I'm going to wait for a few quarters. I need to see what's going to happen with the dividend growth policy moving forward. And I'm still monitoring cash flow metrics every single quarters. The second sector is utilities, so a little bit broader. And whenever I look at utility stocks, on both sides of the border from US to Canada, most Canadian utilities seems better. I don't know why. I mean, I just love their metrics. They seems to be more under control. Fortis by far my favorite in this sector because it's boring and it works and it has gone through decades of all kinds of economic events and still increased their dividend. So kudos for that. A little bit more recent in terms of dividend grower, we have Hydro One that is relatively interesting, relatively stable, and some others. They seems to be just like deluxe bond, like ADCO and its children company, Canadian Utilities. We see like the Brookfields I love the Brookfields, but they have been quite frustrating to hold, both infrastructure and renewables. So I love the thesis. I love the numbers. I mean, they're growing their funds from operation all the time. They're growing their distribution all the time. So what's wrong with those? Well, they don't get much love. Part of it is a really highly complex structure. The second part of it is you must rely on management calculation for the funds from operation, because it's opaque. So that's also the problem. So I understand why it's not getting that much love, and I still hold my shares of Brookfield Renewable at this point. But yeah, I wish they would perform more. So this one, of course, when you're investing in the utilities, you're not supposed to invest thinking that you're going to generate like double-digit return over and over again. Of course, it's going to happen from one year to another, but this should be a fairly stable sector offering good yield, and that's pretty much it what you should get. I mean, technically, utilities should give you a good part of their profit in form of dividend. The rest of it is used for maintenance and growing their ability to generate power and to transmit that power to clients. But again, not necessarily a place where you're going to find growth moving forward either. Moving on to REITs, those have been affected greatly by interest rates in 22, 23. And then it's hard for them to get much love because for several years they had that business model where they could leverage their properties, borrow more, invest more, grow faster. And now this era has been quite over. I mean, we've seen like companies like Canadian Net REIT that was doing incredibly well, a small cap in the REIT in the REIT industry, mostly based in Quebec and Maritime. And then they were growing, like buying of properties after properties, growing their funds from operation double digit for like a decade. And then, I mean, they're struggling to find growth now because they have to manage a large portfolio of properties, and it has been more complicated. When I think of REITs, I mean, I have Granite, which again is a frustrating holding right now. The numbers are still good, the thesis is still good, but not getting any much love. In terms of performance, it's rare to find REITs that have done a great performance over the past few years. Of course, the expected slowdown in immigration is going to also affect a lot of like retail REITs in terms of the economy, and also apartment REITs, of course, because usually immigrants will go and start by renting before buying their own house. So that's going to also put a break on those. So not going to be that easy for REITs moving forward either. Again, good for stable income, not necessarily for growth. So depending on what you're looking for, it seems that the T.U.R.F is getting towards more, oh, you're going to get income, but don't expect to keep up with this kind of like market on fire. Are they going to offer great protection? I would say telcos are not in a great situation right now, so let's not hope for a recession because it's going to be very tough. For utilities, it should be all right. For REITs, they're not getting much love right now, so I doubt that they're going to get much more love during a recession. So I'm not too sure if they will protect your portfolio during a downturn. Actually, I prefer companies with a lot stronger metrics than this, and I focus on low yield, high growth companies. You can find the way I invest at moosemarkets.com/income. You're going to be able to download the dividend income for life guide, which explain my strategy from A to Z, how I build my portfolio. I even have an example of a retirement portfolio based on companies showing very robust metrics, able to grow their dividend over time. Among those three sectors, actually, I would never invest in one of those companies if they stop increasing their dividend. And that leads to probably the most exciting one. I have about a minute to talk about it, but the financials. The financials is actually the sector in the T.U.R.F that is well positioned to keep on providing good returns. We have great asset managers such as Brookfield there. We have great Canadian banks, of course, my favorite, Royal Bank and National Bank, that keeps on growing mid-single digit, steady like a train, generating some good growth in terms of stock price, but also in terms of dividends. So that's great. We do have like a small upcomers such as EQ Bank that are quite interesting to take a look at. Propel Holdings. This one, I mean, it's a small cap. Proceed with caution, but that could be interesting to follow also. And then you have like life insurance companies that have been doing incredibly well over the past 2 years, right? So Great West, Manulife, and Great West Life. They're all on the roll, so that is also interesting. And finally, we have a great stock exchange operator, so Group TMX under X.to. So a lot of interesting financial companies that offers what the T.U.R.F used to be, a mix of growth and stability with a good yield. So you get everything in the financial sector. That sector has been able to maintain that balance as opposed to telcos, utilities, and REITs, where they kind of like turned into more like the stable in income, but not much of the growth part. So if you're looking for a little bit more spices, probably the financial is the one representing the best balance between both. So in the end, T.U.R.F is not dead, but it's not what it used to be. It's definitely more about investing in Deluxe bond than it was, besides the financial sector. So, all right, guys, let me know in the comments. Go on YouTube. Let me know what is your favorite T.U.R.F investment right now. I'm curious to hear about it. We're going to probably have like some names that I haven't discussed today or a chance to discuss. So let's get on YouTube. Let's talk about it, about the T.U.R.F. And I'm going to come back tomorrow with another episode. So until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.